Hello, everyone. Welcome to our boot camp tonight. We're just going to give it 30 more seconds. A lot of people in the queue that we're going to let in, and really excited to get started in just a minute. Okay, folks. Well, with that, I know people are still joining on, but I'm really excited to get started tonight. I can't wait to talk to you about one of my absolute favorite topics, which is acing the technical interviews. This was always the scariest thing for me about being in banking and PE as a candidate, and one of the more fun parts about being an interviewer. So, the reason I care so much about this is that in order to get between where you are and your dream job in banking and private equity, there are three steps. So first is you've got to land the interview through networking. And so that's reaching out to people, that's talking to them, that's trying to get those connections that are going to give you the tie-in to the actual first round interview. And then once you get that first round interview, it's actually usually behavioral. And so you've got to crush those behaviorals. You've got to know your trifecta about why that bank, why that PE firm, tell me about yourself, and why us. And if you don't have those down, you're not going to get the super day. But assuming you do those and you follow those basic steps, the thing that really lands you the offer is the technicals. And so there's a huge demand for people that are 100% focused on the technicals, really understand every nuance thing that they can beyond the basic levels. And technicals are getting harder because there's so many guides out there and so many easy ways to understand the basic technicals that these days it doesn't just really cut it to go into the 400 question guide. And so with that, I'm going to walk you through a brief agenda of what we're planning on going through tonight. And then I want to just hop in and get as many questions out as we can, get you as much practice as possible. So in terms of things we're going to talk about today, we're going to go through, about a dozen of real challenging technicals that I've pulled from top investment banks and private equity firms, including questions that I've asked myself as an interviewer. We're going to try and intersperse some frameworks on how to actually answer some of these questions. We'll have some quantitative and math related things just so you can practice using that mental math. Please no calculators or Excel. This is a chance to practice your mental math. We're going to have hopefully some participation throughout, a lot of things in the chat where you're throwing out answers, and then finishing with some frameworks on where to go from here. And so with that, what are we missing? What other topics would you like to make sure that we see in our tonight's technicals? Please just drop something in the chat if there are any specific technicals, any specific topics you want to make sure that we cover. We'll try and make sure that they get added in. So I'll get one more second there. And while people are dropping those in the chat, I just wanted to give you a quick heads up that in fact we are doing a giveaway tonight. And so we're going to give a giveaway to our investment banking bootcamp coming up pretty soon here. And we're really excited about that, and one to our private equity bootcamp as well. Amanda can correct me on the details there, but this is a great opportunity to get access to a normally quite expensive bootcamp that's going to train you far better than we can just in a session today. And so I love some of the things coming through the chat here. We're seeing a ton of different things, everything brain teasers to understanding how to discuss your transaction experience. And I want to cover as much of that as possible. If we don't get to it all tonight, set up a call, happy to go through one-on-one. But before we jump in, I'm going to give you a little context on me. So I'm a tech investment banking or tech private equity incoming vice president, did backgrounds in banking at Lazard and Qatalyst, and I'm currently doing a joint degree at Stanford Business School and the Harvard Public Administration School. So with that, sharpen your pencils. This is a little bit more on the boot camp. Get ready to track what you catch, track what you miss. And so make sure that you've got a pen and paper handy where you can see what's going well and what's not. So without further ado, let's jump in. So I'm going to give you a bunch of questions now relating to one of our favorite topics in investment banking and private equity, which is the discounted cash flow. So Question number one, let's say that you're building a DCF and you can only pick 5 line items to inform your assumptions. Which do you choose? This is a little bit of a softball. Try and type out your favorite 5 in the chat here, and I'll keep an eye on it. We'll give you about 20, 30 seconds to think through this. Okay, love that. We got someone in the chat already with a few great answers. Okay, Reno, nice. Nice, nice. Just let a few more people drop their answers in there. Larry, Krish, Bree, Avani. Okay, starting to see these plumb in here. Othman, wonderful. Okay, so the right answer here is there's a lot of them. And so I see many, many great answers in the chat. Everything from like, what is the operating income going to be to what is your deferred taxes and your CapEx and your D&A. And those are important. I would argue that these 5 are the 5 most important. So in terms of growth, frankly, the largest driver to a DCF is your growth rate. Is it growing quickly and is that going to generate a lot of cash flow, or is it growing really slow and not going to generate a lot of cash flow? Second, what do the margins look like? If this is a really, really high margin business, then there's going to be more cash flow. The value is going to increase dramatically. But if you're losing a lot of money, then like, frankly, not going to be particularly profitable. Then encompassing a lot of incredible assumptions that many people are putting in here, like Gavin and Zach, I believe both mentioned the taxes and a couple of other sort of cash flow related items. I'm just going to lump those into free cash flow conversion items, saying what happens between EBITDA and free cash flow. And then another big one that some people mentioned, but isn't super common on the chat here is the WACC. This is a super, super important one because it determines exactly how much value you're going to get from these future cash flows. And then finally, last but not least, I think perhaps the most important one on the back end, at least, is the terminal multiple or the perpetuity growth rate. Because as much value as comes from the cash flows of business, in most DCFs these days, especially in tech or other high growth industries, the vast majority of the value actually comes from the end of the business, from the terminal value. And so these are going to be some of the super important ones here. And so now that we've got a little bit of this understanding, let's jump into some rapid fire questions talking about valuation. And so if we have a DCF, what's going to happen to the valuation if this thing changes? And so I'm going to make this a rapid fire. We've got 3 options here, A, B, C, up, down, neutral. And so I'm just going to take 10 seconds for each of these. We've got a few good DCF questions here. Okay, yeah. Okay, bunch of people, it seems like a lot of people are getting this right. This is a softball. We're starting off easy, we're going to get harder. And so yes, indeed, this goes down. If you're lowering the growth rate, as we just suggested, it's not going to help anything in terms of valuation. Okay, next one. What happens to the valuation if the Fed raises interest rates? Up, down, neutral. Love this, love this. We're getting some good ones. Yep. Seems like people are pretty on top of it. Indeed, this is a down. And it seems like everyone here is getting the right answers in general, but feel free to put in a contrarian viewpoint if you ever have a different one. They're going to start to get a little bit trickier here. Let's say that you've got a DCF and you decide to take your underfunded pensions and you recognize them as debt in your analysis. What's going to happen? Love it. Love it. Okay, this is great. We're seeing a lot of good answers here. A couple people saying down, a couple people saying up. Nobody seems to think neutral is the right answer on these. And this one incorrect is up. And so for those of you who said down or something else, the trick here is all about the cost of debt relative to cost of equity. And so when we think about valuation, a lot of this comes back to the WACC, like we were saying before. And so for pensions in specific, traditionally, if they're not treated as debt and then they're moved to being treated as debt, then that's going to lower the WACC because usually the cost of debt is lower than the cost of equity, and therefore the overall WACC will decrease as the percentage of debt as part of the total capital structure increases. Okay, and then a couple more tricky ones, hopefully here, maybe not too tricky for some of you. Let's say we increase capital expenditures as a percentage of revenue, but we also increase the perpetuity growth rate. What do you think is going to happen? Is it going to go up, down, or neutral? Okay, it looks like this one's a lot more controversial. We're getting a bunch of C's, a bunch of A's, some independs, Okay, okay. Looks like nobody's saying it's going down too much, maybe one or two people. Okay, let's see. So overall, my personal impression is it's going to go up. And so I think that we had some great people. So I think William and maybe Nick called this out specifically that the perpetuity growth rate is usually a much stronger lever than the capital expenditures increasing. And so it's tricky to say because like honestly that it's not 100% clear in any given situation like what percentage versus how much the perpetuity growth rate changes. But for an equal change in both, in general, anything that has to do with the terminal value is going to be a massive, massive driver. And so just to think about this for a second, like step with me. So imagine in a DCF, what's a typical perpetuity growth rate? Maybe like 3% or something like that, 2 to 5. If you change that even by 1%, that's going to dramatically, dramatically increase the actual value relative to if you increase the CapEx by 1% as a percentage of revenue, that's really usually not that big of a proportional increase. Okay, so moving forward, we've only got one or two more of these DCF ones. So let's say a company takes out new debt. Is this going to be up, down, or neutral? Okay, I'm seeing a bunch of ups, a couple downs, and then I saying it depends. Okay, yep. And then William talking about the decreased WACC, and then a bunch of people saying it depends. Okay, down, but it depends. Great answers. So in general, I would actually say usually up, but it depends. Because in general, 99% of the time, it's going to be the same principle that we just talked about with the pension liabilities. Whereas we increase the amount of debt, that's going to lower the WACC if the cost of debt is lower than the cost of equity. But the common exception that I think people are mentioning in the chat a little bit is what happens if you tip over that line into becoming bankrupt or so risky as to be even higher cost of equity and WACC overall. And so there's technically a tipping point where you have so much WACC or so much debt that the valuation of the business actually declines. And so it looks a little bit like a curve if you map out the value relative to the percentage of debt. If you don't believe that, go play around with your financial model and see if you can get it to go bankrupt. Okay, so switching gears here, I know that was primarily DCF related, which is usually associated with investment banking as opposed to private equity. But now we're going to switch gears and we're going to talk about a couple of more private equity related questions, and more applicable on both as opposed to specific to DCF. So this is a chance to get out your pen and paper. This is going to be a longer form question than what we've had in the past. So let's say that we've got a company with the following characteristics. What is its tax rate? If the equity value is 1,000, the EBITDA multiple is 12x, the PE multiple is 25x, annual interest is $20, interest rate's 10%, and D&A is $30. So this is a lot of numbers. I'm going to give you guys maybe 60 to 90 seconds to check this out and plug the answers into the chat. Yeah, starting to get some answers in here. And as you're putting it in, feel free to put in your answer. No need to look at what other people are putting in here if you have something different. And we'll go for another 20 seconds or something like that. Seems like the fastest ones are just starting to get done. Okay, I'm gonna give it 5 more seconds here. Get that last answer in there if you can. And ultimately, looks like most people didn't finish in that time frame, but those who did got it correct. And so if you're halfway through the process, let me talk you through what's going on here. So this is essentially one of those like puzzle problems that I call it, where you get a bunch of pieces of information, you've got to like slot it together almost like you're building a jigsaw puzzle. And it's often pretty tricky to get all of the pieces to fit, but usually they give you enough information to answer the question appropriately. One thing I will say though is that sometimes the mean interviewers, they don't actually give you all the information you need and you have to ask it. And so it seems like most people were able to figure it out, but let's talk through how to do this. So first off, you start out with this idea that you have your interest rate and your interest expense, which means you can figure out your debt. And so then if you have your equity value and you have your debt, now you know your
Seen
enterprise
you?
value.
Oh no, I have seen you.
And please just make sure everyone you're on mute so we don't have any interruptions. One other thing that I will say though, nobody did ask about the cash. And in terms of cash, that's actually a key piece that wasn't given, that wasn't strictly an assumption, and does need to be asked about in an interviewer. Since we are on a webinar right now, of course, I'm not expecting that. But when I was interviewing candidates, I would ding them if they didn't catch that piece. So once we have the enterprise value though, and we have an EBITDA multiple, we can actually back into the EBITDA. Then, since we know the depreciation, we can get the EBIT. Since we know the interest expense, we can get the pre-tax income. And we also know the net income. And so it's sort of like we're working towards the pre-tax income from the top of the income statement, and we're working towards the post-tax income from the bottom of the income statement. And ultimately, we converge with this idea that net income's 40, pre-tax income's 50, therefore the tax rate is 20%. Okay, great. Let's switch gears again one more time. Good job on that one. Now we're going to talk a little bit about accretion dilution. And this is a super, super important topic, not just for bankers looking at public companies and companies that are sensitive to EPSs, but also for private equity firms that are doing add-on acquisitions of additional companies into their portfolio. You got to make sure it's accretive. And so I'm going to lay out a scenario, and I want you to tell me if it's accretive. So let's say that the acquirer has $100 in earnings, 10 shares, and they priced at $100 per share. The target, on the other hand, has $200 in earnings, 40 shares, and also price of $100 a share. So if this deal is done all stock, is it going to be accretive? And if you figure that out, then I want you to go tell me what the implied synergies are for break even. We'll give you maybe a minute and a half here, and we'll drop it in the chat. Okay, starting to get some good answers in here. Make sure that if you do say it's dilutive, that you've got an implied synergies required to break even, because if it is dilutive, then there's a break even point. So Michael and I and BSB, just make sure that you have you're working on your implied synergies as well. Great, we'll give it 20 more seconds here just to give everyone else a chance to work on it. And then while people are finishing up, Carmel is asking a funny question, which is, since the acquirer is actually smaller than the target, how would this deal work? That's a great point. Realistically, it probably wouldn't, but that does happen sometimes in private equity where you get a sponsor that's backing an individual company and just infusing a lot of cash. Pretty uncommon. Bear with me. These are stupid numbers demonstrating principles. So I love the investor judgment there. Okay, so let's see what happened. There was a little bit of a mixed response between accretion and dilution. And so no, this is not accretive. It is in fact dilutive, and you need $200 of synergies, which did come across as one of the more common ones here. And so the first tip I want to just share here is the PE ratio rule. And I think a lot of people already knew this, but in general, when the target's PE ratio is higher than the acquirer's PE ratio, and it's an all-stock deal, and there aren't synergies, et cetera, it's going to be diluted. And so in this case, we know that the acquirer has $10 of earnings per share, and they're trading $100 per share, so it's a 10x PE ratio. Whereas the target has $5 of earnings per share, and it's a 20x PE ratio. And so we almost certainly know at this point that it's going to be dilutive since it's an all-stock deal. And so then how you actually calculate that is you take the earnings of the target and the acquirer, you combine them, and then you divide it by the pro forma share count. And so where we got the pro forma share count, this 40 here, this one is a little bit tricky. It's basically taking the target's value divided by our share price. And so since there are 40 target shares at $100 per share, that's $4,000. Divided by our acquirer's share price of 100 is 40, meaning you get 300 divided by 50 is 6. So that's a little bit complicated. And that gets you to whether it's accretive or dilutive. It's dilutive because the earnings per share went down. Then the second part of the question is, okay, and what are the break-even synergies? And so the way to calculate this usually is to take the difference in the pre-deal and the post-deal earnings per share and multiply it by the number of shares. And so we get that $4 difference times 50 shares equals $200 of total difference. So that's how you get the answer there. And I recognize that was moving fast. So if any of you are feeling a little lost right now, do feel free to take a second and sign up for a quick 15-minute intro call where we can talk through the answer to that question or any other technical that you want. And I recognize we're moving at a fast pace here. So with that, let's get ready. We've got one more incredible accretion dilution question before moving into a couple of other interesting questions about equity value, enterprise value, and market capitalization. So with that, we also want to just hype again our boot camp coming up. It's going to be incredible in April and in May. We are doing a boot camp, and at the end of the session, we're going to announce some of the winners to that. And we're covering a bunch of really, really deep topics on this sort of thing, more detail on technical questions, some LBO modeling, some paper LBOs, just really, really incredible curriculum. And I'm hoping to teach some of that as well. So if you like working together, that's another chance to do it. So with that, get your pencil sharpened. One more accretion dilution question here. Similar setup here, where we've got an acquirer with $200 of earnings, 10 shares, a 5% cost of cash, and a 20% tax rate. They're trading at $100 a share still, and then the target's the same. It was 200 earnings and 40 shares with $100 price per share. So same question, but this time, instead of being all stock, it's 50-50. So we got 50% cash, 50% stock. Is it accretive? And this time, no need to calculate the shared or the synergies yet. That'll be the next question. So for now, just focus on, is it accretive or dilutive? Okay, we'll give it 15 more seconds here just so everyone can wrap it up. We're starting to get some good answers in the chat. I know this one's a lot trickier than the others, and it looks like we're actually pretty mixed. We're getting a bunch of A's, a bunch of B's. We'll see. Okay, with that, let's move forward. Drum roll. And in fact, it is dilutive. And so let's walk through why. So the way I think about it is this time the acquirer was different, the target was similar. And so we had $200 of earnings and 10 shares, meaning we had $20 of EPS. It was at $100 of price per share, therefore a 5x PE multiple. The target, on the other hand, was $5 of EPS. We had $200 of earnings, 40 shares, and a 20x PE multiple as a result. And so then in terms of the accretion dilution, the way I usually like to think about it is just calculating out, okay, what was the total value of acquisition? So it was 4,000 to acquire it, and then 2,000 of that was in stock, and 2,000 of that was in cash. So for the stock period, we take the 2,000, we divide it by the acquirer share price, which is 100, and that gets us plus 20 shares. Good. Then on the cash component, we've got to treat that separately. And so a lot of people here make the mistake of multiplying 2,000 divided by 5%. And so that's great, but they forget about the taxes because you have to pay taxes on that cash. And so the post-tax interest that you're earning on the cash is actually only 4%. And so 2,000 times 4% is an 80 hit to earnings. And so taking that all together, we've got two moving pieces here. We've got the share count changing. We've got the number on the top changing. And so overall, we take the acquirer earnings plus the target earnings, less the hit to cash, divided by the newly increased share count. And so overall, our EPS goes from $20 a share down to $10.67, meaning it's pretty dilutive. So great job to all of you who got that. Let's figure out next, what are the synergies? And so calculate, if you can, using some of the principles that we looked at to figure out the synergies to break even. And then after that, we've got two really, really tough questions about capitalization. I'm really excited about them. Okay, starting to see some good answers here. We've got Bree, we've got Dewey. Apologies if I'm mispronouncing. Mai Hong. We'll give it another 20, 30 seconds. It seems like this is taking people a little bit to do the math. Kushagra, Aman. Nice. 10 more seconds here. Anders and Nicholas. Okay. And Ryan. Okay, Ryan Pradeep. Nice. Closing us out. So in fact, everyone got it exactly right. This is just purely a mental math problem. And so you all saw the process in the last accretion dilution question where we're taking the amount dilutive times the shares. Same concept here. So we're taking the 933 multiplied by 30. And if that's a hard mental math problem for you, the way I would separate it up is into two parts. So first, 9 times 3 is 27. Add in a 10 to that, that's 270. And then the second piece is taking the cents times 30. And so 33 cents is a third of a dollar. A third of 30 is 10. So you take the 270 plus the 10, you get the 280. And one common mistake that I get there is failing to use the pro forma share count. And people will just use the target or the acquirer share count, and that's going to get you a slightly different answer. Okay, so with that, we come to perhaps some of the harder questions that I've ever asked as an interviewer around capitalization. And so I'm going to ask you this question. I'm going to talk you through a couple things, and then we'll see if we can calculate it. So let's calculate some market caps. Let's say that you have a company that has 800 million shares outstanding. It's trading at $50 per share with 80 million RSUs, 40 million options at a $25 strike price, 40 million options at a $50 strike price, and $4 billion of convertible debt with a $1,000 face value and a $40 conversion price, treated on a no capped call if converted basis, otherwise debt. What is the fully diluted market cap? So for those of you who know what all those terms mean, go ahead and get solving it. Anyone who's a little bit confused here, this is a tricky question because it requires you to understand a lot of different things. First off, the difference between basic and diluted shares outstanding. Second, what RSUs are, restricted stock units. Third, you got to get your treasury stock method busted out in terms of the options with these two different strike prices. And then finally, the convertible debt is tricky for a lot of people because it involves understanding what a face value is relative to a conversion price and how to treat that. So I'm going to give people a second. Seems like we have some all-star fast math people here, Arnav and Bri again, and Dewey and Mai Hong. You guys are really crushing it. And definitely going to be the top scorers in this next recruiting cycle at this rate. We'll give it 30 more seconds here. Got Kushagra and Reno. Nice. Tina. Got 10 more seconds here. Okay, great. Nice job, John. And the answer, everyone got it right. That did get it was 50 billion. And so let's talk through that because my sense is that probably the vast majority of people watching this might be scratching their heads and saying like, what's going on? And that's totally fine. I'm not expecting everyone here to get this right, especially if you're just recruiting for your first investment banking position or an analyst position at a PE firm. So let's talk through how we do this. First off, basic shares outstanding. RSUs, you add into that, the 80 million, because those are basically just treated as shares in a transaction. Then you run the treasury stock method on the two tranches of shares. Since one of the tranches was at the money, so it was at a $50 strike price and a $50 per share, you can ignore that. The other one, though, that's at $25 a share, you do have to run treasury stock method. So you take the $40 million of shares, but you buy back some of them using the proceeds. So the employees are going to pay $25 per share times 40 million shares, divided by the stock price. And it turns out the net dilution from that tranche of options is only 20 million. Then you add in the 4 million times 25 from the convertible debt. So where did we get that? This is the hardest part for most candidates. First off, we have $4 billion of convertible debt at a $1,000 face value. That means we've got 4 million bonds, like 4 million like instruments outstanding. But how many shares does that translate to? And that's where you've got to take the ratio of the face value and the conversion price. So you take the $1,000 divided by 40 to get 25 shares per bond. Then that gets you to the 100 million. And so that gets us to a billion total. Multiply that by 50, $50 billion. Okay, great. And then one more key question about enterprise value. It's the same company as before. We had $50 billion of equity value. But now we're trying to find the enterprise value. So let's say that you have a term loan of $3 billion principal value, subordinated debt of $2 billion principal value, $500 million line of credit, where we've only exercised half of it. You've also got non-controlling interest of 250 million. On the cash side of things, you've got 2.5 billion, of which 500 million is restricted cash. You got $2 billion additionally of liquid short-term investments and 1.5 billion in liquid long-term investments. What's your enterprise value? And this one's also a little bit tricky. Requires a lot of definitions and really, really deeply understanding what goes into enterprise value. Okay, we got some answers coming out here. We've got Daniel and BSB and Mai Hong, Dewey, Bree, Nicholas, Jack, nice, Alexa, Arnav. And it looks like we're getting a wide range of answers here. So this one might be a little bit trickier than the equity value question was. Sam, Zach. Ryan, Nick, Tina, Gavin. Okay, okay. Give it a few more seconds here. William, Anthony, Gavin, nice. Okay, maybe 5 more seconds here. Okay, let's see how we did. Seems like a lot of people are saying 53, and I'm going to respectfully disagree that in fact, the equity value is the same as the enterprise value. So let's talk about why. So in this case, we start with the $50 billion of equity value. And then I think everyone here agrees that we add the term loan, we add the debt, the subordinated debt, that gets us to 55. And then on the line of credit, the only tricky thing here is make sure that you're only adding the exercise portion. I think some people accidentally added the full portion, even though that's not drawn. That's sort of unfair. It's like saying, hey, you've got, $20,000 of debt because you've got a credit card with a $20,000 limit, even though you don't actually have a balance. And then the non-controlling interest, fairly straightforward. You add that in at 250 million. The part where I think people probably got tripped up was these liquid short-term and long-term investments. So you start out with the cash, subtracting the 2 billion after cutting out the restricted cash. And so a lot of you probably are wondering, like, why don't we include the restricted cash component? Well, a couple reasons. First off, it's not liquid. And so therefore, it couldn't be actually used it couldn't actually be used to like offset the cost of financing. And so the way that I think about cash in an enterprise value setting is like, unless it could be used to offset the cost of acquisition, it's not really cash. And then second, because it's restricted cash, that means it's actually probably used in the operations of the business. And as we all remember, the definition of enterprise value is the operating assets of the business, the value of the operating assets of the business. And so we don't want to subtract out operating cash, which is the 500 million restricted. And then the last thing I'll just say is we do in fact subtract out the liquid short-term and long-term investments because those are liquid and they can be used to offset the cost of acquisition. And that is a really, really important piece that I think a lot of people were getting slightly off when they said 53 billion or something like that. And so honestly, congratulations to Bree on this one, who I believe was the only one to get this right the first time. So congratulations on that. That's incredible. And so with that, I want to talk a little bit about how to study. So everyone here probably missed at least one of these technicals and maybe most of them. And so what the heck are you supposed to do with that? And so I want to talk about how to study. So there's really two sides of it for me. The first is the theory behind it. And this is the stuff where it's like, okay, like theoretically, like how do I treat a deferred tax asset? Or like, what is the definition of enterprise value? But there's also a practical component to it where it's like, okay, that's great. You probably all took finance classes in university, but Do you know how to answer questions in an interview under fire when someone's grilling you, like tonight? And so on the theory side of things, the best way to study that is, school courses, Wall Street Prep, Wall Street Oasis, Train the Street, any of those packages where you can go and buy a couple videos and learn about basics of accounting, and also just tracking questions as you go through these. On the practical side of things, the way that I like to think about it is starting with a guide like the 400 question guide or the Wall Street Prep Red Book. These are incredible, incredible tools that you can access through the PDFs or through, there's ibvine.io is a great resource to like sort of feed them into a flashcard format. And there are Quizlets out there also that stop you from just reading the guides because it's so much more effective when you actually quiz yourself. And then, especially if you're looking to get better at modeling and you're focused on the PE side of things, hit up Peak Frameworks or something similar. These are incredible, incredible tools to actually help you get into Excel and apply some of these theoretical knowledge pieces into a financial model in a way that's going to help everything come together. And then lastly, on the practical side of things is mock interviews. So if you can't make it work with a coach like me at Leland, try out GPT. It might get the answers wrong sometimes. It's not perfect, but it can help. And it can help you work on some of these things. And then once you feel really, really ready, come on by Leland, grab some time with me. I'd love to spend 30 minutes, an hour, 2 hours doing a technical diagnostic, understanding where you're strong, where you're weak, and where you need to study. And then once you know that, take some time to like block out time because there's really no substitute to just putting in hours and hours of work. And so in general, I recommend my candidates who are very, very successful in these interviews, who've landed jobs recently at, Goldman and JP Morgan, Morgan Stanley, Houlihan Lokey, and a bunch of boutiques like Accretion Partners. They study for at least an hour a day on weekdays and 3 hours a day on weekends. I know that's a lot. Not everyone has that amount of time, but that's what the best candidates are doing. And then the final hack that I'm going to say before we announce our giveaway winners and open it up for a bit of Q&A is see if you can distract people by having a really, really interesting set of behaviorals. And so that was my hack when I was going through a lot of this recruiting originally back in the day. Whereas I had a lot of really interesting interests on my resume. And when people asked me about my story, I was able to get them engaged in conversation. And so frankly, I didn't have to answer a whole lot of technicals. And so if any of you are worried about not getting all the technicals right tonight, see if you can make sure that your behaviorals are strong so that you can avoid even getting asked in the first place. And so with that, we're going to have a few minutes of Q&A, and we're just going to hold open for the giveaway winners. And I believe that Amanda is going to announce that. It looks like we've got a PE bootcamp winner of Santiago Rodriguez and Benedicte Betana on the IB side of things. Congratulations on that. And for the rest of you, as we open it up to just maybe 5 minutes of Q&A, I would love to just invite you all to schedule some time to connect and make sure that we're able to build a little bit of a relationship. I'm going to drop my LinkedIn in the chat, and please send me a quick note on LinkedIn if you add me, because otherwise I'll think it's spam. So with that, love to hear just a few questions. So Juan, please come off mute and share.
Hi, how are you? I just want to introduce myself. I'm a freshman studying over by Rutgers, Newark. And I'm honestly just trying to get ahead on my technicals. And I wanted to ask, what do you recommend for somebody that's so young at my age, really trying to get down these aspects? And I know you talked about the 400 questions, and I know you talked about things like Wall Street Prep. But what are some other options, especially for me, that I don't have to necessarily know them, but it's a great skill to have at my age? So what would you recommend for that?
Yeah, it's a great question, Juan. So for a lot of students who are in school, I highly recommend, highly recommend just taking as many classes as possible, starting to build that fundamental knowledge and then getting involved with case studies and getting involved with clubs, because that's sort of the basis where you're going to be around people talking about these issues and you're going to be learning about them in a really, really powerful and applied way. And so when possible, get your hands dirty in the clubs, get your hands or your head dirty with the sort of theoretical elements of the classes. Thank you for the great question there. And then, yeah, Kushagra, please come off mute and love to hear your question.
Thank you so much, by the way.
Absolutely.
Hi, thank you for hosting this. It's been an amazing experience getting to do all the technical, especially on the latter half. I was wondering, you mentioned you had a lot of interesting interests on your resume that helped you with the behavior sections. Could you speak a bit more to that? Like what sorts of interests are we talking and how you would incorporate them into the interviews themselves?
Yeah, it's a great question. So the one that always gets the most answers or most questions in my interviews is I usually have on the bottom of my resume, I've read about 190 books last year and I list a few of my favorites. So I'm a massive reader and people are always like, oh my gosh, Max, how'd you read so many books? And that's kind of starts a fun conversation where I get to talk about something I love and they get to talk about something that they're interested in too. And so between those, we're usually able to have a pretty good conversation, but people often put things like a sport that they're excited about. They might put a hobby that they have, a culinary taste that they enjoy cooking, a place that they've traveled. And so just think about what makes you interesting, Kushagra, and like what your friends are excited about when they talk about you. And so that's the sort of stuff that's going to get people distracted in an interview. I'd also recommend shooting for what I call optimal distinctiveness. And so in terms of optimal distinctiveness, I would say you want it to be distinctive enough that you're able to build a relationship with people, and you want it to be broad enough that people can connect to it. And so if you have an interest that's too niche, nobody's going to know what it is. But if it's too broad, saying, hey, I like sports, that's probably not going to be interesting. And related to the question that I believe I got from Ballesteros, yes, I do play some sports. I run marathons, I'm training, I am a boxer, and I'm a climber. So thank you, Kushagra, for the question. Anyone else want to raise their hand and come off mute?
Just want to say thank you. That's perfect.
Absolutely. We have time for maybe one or two more questions. Please raise your hand or come off mute and shout it out.
Hey, can you hear me?
Yeah.
Sorry, I couldn't figure out how to raise my hand, but how would you go about crafting your behavioral interviews and what feedback do you have on that?
Yeah. Well, so first off, I will almost certainly be hosting a webinar on that in the next couple months. So please be sure to check my page out and sign up for it where I talk in more detail. But in general, I recommend a very structured, story-based approach. And so on your tell me about yourself, I recommend having a pretty clear structure, so talking about your headline, your background, your spark on your interest in finance, your development section, and then going through to talking about how that ties back to the bank or private equity firm you're interested in. And then for the why banking and or why PE and why this firm, I always recommend adding structure. So saying something like, great question. I'm interested in investment banking for three reasons, then have three solid reasons, A, B, and C. I know that's dissatisfying. There's so much more to talk about. That's a 20-hour question right there, but that's the basics. And I would definitely encourage you to set up some time so we can talk through some behaviorals. But with that,
Thank you.
folks, yeah, absolutely. Unfortunately, we are out of time here. I've really enjoyed getting to know some of you, and thank you for joining me tonight. So please feel free to add me on LinkedIn, set up a free intro call. I'd love to get to know you better soon. Please stay in touch for my next webinar, and we'll be in touch. Bye-bye.